Hi, everyone. This is RC Peck, the founder of Fearless Wealth and the creator of the Fearless Wealth platform and portfolio. And my market situation report this week is about seeing things that most people can't see. In the medical industry, most of you are familiar with the idea that doctors use equipment to see inside the human body to see what's going on. Sometimes they use CAT scans or MRIs or PET scans or even an X-ray. And an X-ray is really the original way of looking inside the body and seeing what is happening. And so for years I wanted to figure out, well, how can I X-ray the market? How can I look inside the market and see where I should be, where I shouldn't be, which still stays with the idea of keeping the big picture and getting the big picture right. But it's kind of giving you an unfair advantage. And the way I think about seeing inside the market is if you could, see inside people's briefcases and see where the money is and see where the money isn't. And so what I want to do is kind of pull the curtain back and show you one of the tools that I've been using for years as without sounding too hypey, one of my secret weapons that really shows me where I should be and where I should not be. And it really has felt like an unfair advantage, and I want to share that with you. So let me bring up what I call my sector X-ray, and this is inside my club site. And so the first thing I just want to bring up on the screen is what I call market X-ray. And actually, let me just make it a little bit bigger so it's easy to see. You got that right there. And so what I just want you to look at is what I just call these slide rules right here. So look at the NASDAQ right here. All four of these are being compared against the S&P 500. And you can see the minimum it's been and the maximum it's been. And I haven't said what it is yet. And then you can see what the typical range is. So what we're looking at is a ratio. And the ratio is measuring and marking which of these indices is moving faster against the other. And all four of these indices are being measured against the S&P 500, which I'm using as the general stock market. So as of right now, the NASDAQ is moving back. It was moving ahead, but right now today it's going to the left. It is moving up at a slower pace than the S&P 500, which probably means you don't want to be in it right now. But then go down here to small cap and mid cap. Look what's going on with both of these. Right now today, small cap is moving faster. Small cap stocks are moving faster than the overall stock market, and mid cap stocks are moving faster than the overall market. So people who want to have kind of an unfair advantage, you want to know what those internal workings are. And right now we can see from the market X-ray that small cap stocks typically under $1 billion market cap, and mid cap stocks typically under, say, 20 billion, $1 to $20 billion market cap. So those are moving much faster than the stock market itself. And you can see large cap stocks they're not lagging, but they're just in its typical range. So there'd be no reason to take on additional risk and go just right into large cap when you'd have less risk owning the overall market. So market X-ray today is saying be in small cap, be in mid cap. Now, we are coming up to a major resistance point, which is new lifetime highs on the S&P 500. So we will probably get some correction. A 5 or 10% correction would be very expected. And if that's true, then where you want to be looking is the small and mid cap stocks, because those will also fall a little harder than the overall market. But that's your advantage because the volatility will give you a better buy price. So the takeaway from the market X-ray is small cap and mid cap are clearly beating the overall market, and you probably want to stay away from technology and large cap right now. I wanted to quickly, with a few minutes, just go down to sector X-ray, and there's a lot of sectors in here that I follow that are in here, but I want to point out two quickly, and one of them is right here, the financial sector, and you can see right now it has been underperforming the overall market for, well, it looks like quite some time because it's way over here on the minimum side because typical is way over here. So let's just quickly zoom in and go inside this ratio and let's see what it actually looks like so we can get a better view. And again, financials have been underperforming for so many years. Now, this price chart you're looking at is a 2-year price chart, and you can see from about October, November in 2011, financial stocks stopped falling in relationship to the overall market, meaning they were falling much harder than the stock market, but that changed at the end of 2011. And when you see this price line rise, that means financial stocks, the financial sector, is moving at a faster rate than the overall market. So it's worth the additional risk to go in and buy the financial sector. And yes, you can go in and buy individual stocks in there too. That's fine. But what's so nice about these x-rays, it tells you which ones are performing and overperforming and underperforming. And you can see if I zoom back and just take in a lot of data here, going back to 2007, you can see for almost 1, 2, 3, 4, 5.5 years that the financial sector has been underperforming. But now, as of the end of 2011, even though this looks really flat here, it is moving up at a faster rate, and I'll just zoom back into that 2 years. It is moving up at a faster rate than the overall market, and this is an unfair advantage because you can see why you may want to be in the financial sector. I wanted to show one more, one that's gotten beat up. Look at telecom down here. It's still in the minimum. It's underneath the typical range, but look, it's moving faster than the overall market. And so what I want to do is just zoom in and look at how telecom is doing in relationship to the overall market and say, hey, is it worth it to buy the telecom sector, or is it not? And look at this in July of last year, maybe July, August of last year, it started moving up. It started moving faster than the overall market. This is why you want to maybe be in the telecom sector. And it's been underperforming the market for a long time. We'll go back to this 2009 peak. So it's been underperforming for 4 years, about 2 years, 3. I'm doing it about 3 years. But now it's not. Now it's outperforming. This is unfair. This can be an unfair advantage for you. We don't have time for the commodity X-ray or the global metal oil X-ray or the rates X-ray or the global X-ray, but we'll get to those at other market situation reports. The point is, and let me go back to my PowerPoint, that when you can look inside the market and see which sectors are moving faster than the market, then it's worth it. And as important as that is knowing which sectors are underperforming. Why would you want to be in an underperforming sector and take on that additional sector risk if you could have the overall market with lower risk, lower volatility with your money growing faster? The answer is you really wouldn't. So I'm glad you guys were here. As always, I want us to keep the big picture in mind. I want to make sure we're on the right side of the market and always be adapting to what is happening. I have my monthly strategy gathering coming up this Tuesday. Of course, we're going to look at stocks, bonds, commodities, currencies, real estate. We're going to have speed investing. That's where you look at any stock picks you want. And of course, you can personally ask any questions about our portfolios or any stocks or investing you have. I'm so glad you're here, and I look forward to seeing you on Tuesday. You take care and have a great rest of the weekend.